If you want to buy stocks of Amazon, Apple, Tesla, then watch how Chris bought stocks of his own friend's company. Meet Jake and Chris, two best friends. Jake had a dream. Jake loves pizza, and he wants to open a pizza shop of his own. His pizza is awesome. Everyone in his circle loves it. But here's a problem. Jake needs $10,000 to open a shop, buy the equipment, buy ingredients, and whatever. But Jake only has $5,000 left in his savings. He is short by $5,000. So, what does he do? Jake goes to his close friend Chris and says, Chris, I need $5,000 to open my pizza shop. I know it's going to do really well. So here's my offer. If you gave me $5,000 today, I will give you 50% ownership of my pizza shop. Chris thinks about it a little bit. He trusts Jake. He tasted the pizza. He knows it's good and will really work. So Chris says, Deal. Let's do it. Now Jake has his $10,000. He opens the shop. Now let me stop the story here and explain something important to you. What Chris actually just did, this is exactly what buying a stock is. See, Chris gave money to Jake's business, and in return, he got ownership in that business. In the real world, big companies do the exact same process. Instead of asking one friend for money, these companies ask thousands of people. And each small piece of ownership they sell, that is called a stock or a share. When you buy a stock, remember this. You are buying a small piece of a company. You become a small owner of that company. Okay, back with Jake and Chris. The pizza shop opens and it becomes a massive hit. People coming from cities just to eat there. After 1 year, the pizza shop is now worth $50,000. But remember, Chris owns 50% of it. So Chris's share is now $25,000. He just invested $5,000 and now he has $25,000. Amazing, right? That's a 5 times return. His money grew 5 times. That is how people make money from stocks. The company grows and your ownership grows in value. But what if it goes wrong? Now let's talk about the opposite side of the story. What if Jake's pizza shop fails? Bad location, poor management, and nobody comes to buy the pizza. After 1 year, the shop closes down. It's worth now $0. Chris will automatically lose his $5,000 that he invested in Jake's business, no matter how much he invested in Jake's business. This is the risk of stocks. See, if the company does well, you'll make money. If the company does bad, you lose money. Simple as that. This is why people say never invest money that you cannot afford to lose. Now, in the real world, you are not going to your friend's pizza shop or somewhere else. You're buying stocks of companies like Apple, Amazon, Tesla, Google. These are giants and they have already sold millions of small pieces of ownership called stocks to people like you and me. You can buy one stock of Apple today and become a small part owner of Apple Company. Cool, right? You and me buy stocks on something called the stock market. Think of the stock market like a big marketplace, like Amazon. But instead of buying products on Amazon, you are buying and selling ownership pieces of Amazon Company. In America, the two biggest stock markets are the New York Stock Exchange and the NASDAQ. You access them through an app called a broker. You open an account, deposit some money, as much as you want, and start buying stocks. Simple as that. Here's something important. Stock prices change every single day. No, every minute actually. Why? Because the price of a stock depends on how many people want it. If people believe Apple is going to grow, they will buy Apple stocks. High demand, price automatically goes up. If people get scared, maybe Apple had a bad day, they will sell all their stocks and the price goes down. It's simple supply and demand. Now let's go back to Jake and Chris one more time. Jake's pizza shop is doing so well that he decides to expand his business. He wants to open 10 more shops across the country, but now he needs $1 million. He can't get that from one friend alone. So Jake does what big companies do. He goes public. He divides his company into 1 million small parts. Each piece is worth $1, and he sells those pieces to the public. Anyone can buy a piece for just $1. Those pieces are called stocks or a share. This process of a company selling stocks to the public for the first time, this is called an IPO, initial public offering. So here's the conclusion. Point number one, a stock is a small piece of ownership in a company. Two, when you buy a stock, you become a part owner of that company. Three, like if the company grows, your stock becomes more valuable and you make money. Four, if the company fails, you lose money no matter how much you invested. Five, stocks are bought and sold on the stock market. That's it for today. If this video helped you, give it a thumbs up. It really helps the channel to grow. See you in the next one.